Hi, I'm Monk and this is the Monk Way. In this video, I'm going to show you exactly how you can get rich with a Vanguard index fund. This is the easiest way to make money in the stock markets, without knowing any of the technical details of stocks. Definitely one of the most important lessons on finance. I know this is a stock market channel, but even I have half my money in these Vanguard funds. So I really believe what I teach in this video. Subscribe, hit the bell, and leave a like for more simple investing videos. I make these every day. And check out Monk's Market Mastery below for a fully animated course on the stock markets, teaching you more about passive investing and active trading. 50% off for the first 10 buyers. I also have links to the best investment apps. Webull lets you buy these funds for free, so you can sign up and buy a Vanguard fund today at no cost. They also give you 2 free stocks worth up to $1,000 just for signing up and depositing. M1 Finance is also free. You can buy partial shares of these funds for pennies. If you have very low money, this is the perfect app to start with. Links in the description below. Before we get to the funds, let's have a quick recap on index funds. An index fund is like a single stock you can buy that contains a whole bunch of stocks at once. This means you can buy the entire American markets in one stock. So we have bigger companies like Amazon, Apple, Facebook on top, and smaller ones like Walmart, Costco, AT&T, Procter & Gamble, etc. Bigger companies have more effects on the price, and smaller ones less effects. When you buy a Vanguard fund that tracks the S&P 500, your money will move up with all 500 companies in the index. This is why index funds are the best source of passive income. You can buy it once every month and watch your money grow with the markets. This is very passive, so it costs very low fees. A mutual fund might actually cost you 20 times the fees, so I would avoid mutual funds. Index funds usually come in the form of ETFs, or exchange-traded funds. You can buy these with a symbol like VOO for the Vanguard S&P 500, just like buying a share of Apple stock for $200. You can buy the Vanguard fund for $270 a share, and that one share goes up with the 500 stocks in that fund, meaning you own a very small part of all 500 stocks like Apple, Amazon, Netflix, Facebook, and everything else in it. When people talk about an index fund, they're referring to an ETF most of the time. There are many funds that follow the same index, the most popular index being the S&P 500. Another popular fund might be the SPY, which has a higher fee. This is a good reason to stick to Vanguard, the low fees. So how much can you really make with these funds? With the power of compound interest, just investing $400 a month at a growth rate of 10% a year will give you over $2.5 million after 40 years. That small 10% a year made you $2.3 million of profits. Without the 10% a year, you would have only saved $192,000 after 40 whole years. But 10% a year is not guaranteed. The S&P 500 has returned an average of 10% a year for the past 100 years. Accounting for inflation, that $2.5 million is worth $1 million in today's money. Basically, you retire a millionaire if you can save $400 a month. You'll get $5 million if you save $800 a month, and $7.6 million if you can save $1,200 a month. Time is the biggest factor when investing in these funds. This is why I teach beginners who ask me about stocks all the time. I tell them about compound interest and index funds, because the average investor who don't want to pick stocks should just buy the index and average in over time, meaning buy more every month whether it goes up or down. You will likely end up a millionaire if you do this correctly. If you learned something so far, please drop a like below. This video actually took me 12 hours to make. Hours of research, scripts, and the voiceover took 30 minutes. The animation was brutal because of the length. Just clicking the like button helps so much. Subscribe too if you're learning. So what are the best index funds you could buy? I believe Vanguard currently offers the best deal of all the funds. This is because of their extremely low fees. Their funds has an expense ratio that's 73% less than the industry average, and 84% of the funds perform better than other funds over the last 10 years. There are quite a few funds that might track the same index, like the S&P 500, and the performance won't be exactly the same. Vanguard funds has higher performance, so better returns, lower fees. They started back in 1976, and was personally recommended by Warren Buffett, so you don't have to worry about security. If you go to their website and see a list of funds, you can purchase these funds with any stock brokerage like Robinhood or Webull. Just enter the symbol and select how many shares you want. Vanguard offers accounts on their sites that allows free buys, but it makes more sense to stick with your brokerage if it's already free. The one I personally invest in, I recommend for beginners to look into, is the S&P 500 with the symbol VOO, only $270 per share. This is the one I mentioned earlier in the video. Let's take a deeper look. First of all, it has an expense ratio of only 0.03%. This is not 3%, this is 0.03%. An investment of just $10,000 will only cost you $3 a year in fees. $100,000 will cost you $30, almost nothing. Compare this to the SPY, another fund that tracks the S&P 500, which has a ratio of 0.09%. You're paying 3 times less for Vanguard, meaning if you have $1 million, you would pay $900 a year for the SPY, while paying only $300 a year with Vanguard. This can save you thousands of dollars over a lifetime. A fund is only as good as its returns, so let's take a look at those. First of all, this has a nice 1.98% dividend, meaning you're getting paid almost 2% a year of your money back. $1 million invested will get you $20,000 a year. Let's look at the actual returns. Since we're in the bull markets, these returns might be a bit high. As of this video, we saw 10% in the past year, 14% a year in the past 3 years, 10.7% a year in the past 5 years, and a huge 13.9% return a year in 9 years. This means if you invested in this fund in 2010, you would have gotten 13.9% every year over the span of 9 years. Let's see what an investment of $100,000 would be now. After 9 years, that $100,000 turned into $320,000. That's a 220% return in 9 years if you bought more of the dividends. These are the factual numbers. If you invested $100,000 in 2010, as simple as buying VOO in your brokerage, it was only $100 a share. So you would get 1,000 shares, and you would have $320,000 right now. Because each share is worth $271 right now, that's $271,000, and you get an extra $50,000 from dividends. I would say that's an amazing return for doing almost nothing. Since we want to know what we're investing in, let's look at the sectors in this fund. There are 508 stocks in VOO, 10% in communication services, like AT&T or Verizon, 10% in consumer discretionary, like McDonald's or Nike, 7.6% in consumer staples, like Procter & Gamble or Johnson & Johnson, 4.4% in energy, like Enbridge, 12.8% in financials, like Bank of America, 13.9% in healthcare, like CVS, 9.2% in industrials, like Caterpillar, and a huge 22% in information technology, like Apple, and a few more percent in materials, real estate, and utilities. The biggest holdings are Microsoft, Apple, Amazon, Alphabet, Facebook, Berkshire Hathaway, JP Morgan Chase, Johnson & Johnson, Visa, and Procter & Gamble. There's a huge diverse portfolio in here, but I would say, since the top companies are mostly technology related, they might be heavy in tech. This is a very stable index, with an average return of 10% a year over the past 100 years. It's a good index to start with, especially if you're a beginner, and it's the one I would put half my money in. Warren Buffett says for the average person, they can have almost all their money in this index and come out ahead. That fund was very focused on American companies. Let's look at one that's more focused on every country on the planet. This means a lot more diversity in case America falls. The Vanguard Total World Stock ETF is amazing, symbol VT. It actually contains over 8,000 companies in one, and it's only $74 per share, 0.09 expense ratio, so a bit more expensive. With a nice 2.29% dividend, because this is so diverse, it has less growth compared to the S&P 500. In 10 years, it went up 10.4% a year on average. So $100,000 invested in 2009 will give you $230,000 right now. That's a 130% return, not bad at all. The biggest holdings are still American companies like Microsoft and Apple, but we also have other countries in the mix. 55.8% is America, 7.6% is Japan, 4.9% is United Kingdoms, 3.2% China, 4.1% Canada, and so on. Pretty much 50% of these stocks are foreign to America. Diversity is key when it comes to passive investing. Yes, America as a whole has beaten most other countries in the past 10 years, but this is not a certain thing. You might want to hedge your bets on other countries like China, beating America in the coming years. While the American market might have a recession, this fund will give you a lot more security. I can't say this is an easy choice to make because no one knows, but what I can say is, the more diverse, the less volatile your money will be. This means this fund might drop down 30%, while the S&P 500 drop 50%. For the investor who wants to invest in the whole world, America as a whole can fall, Japan can fall, but the whole world falling is not likely. Let's move on to a safer investment, perfect for a possible upcoming recession. The Vanguard High Dividend Yield ETF, with the symbol VYM, only $88 a share, with a 0.06% fee, and a 3.39% dividend, one of the highest dividend yields. You want to get paid when everything else is dropping, and this one will be paying you 3.39% a year. This fund has grown surprisingly fast in the past 10 years. If you invested in 2009, you will be up 230%, meaning this is on par with the S&P 500 in returns. But the main difference is the holdings. There are 418 stocks with a focus on high dividend yields. On the top we have JP Morgan Chase with a 3% dividend, Johnson & Johnson with a 3% dividend, Procter & Gamble with a 2.4% dividend, AT&T, Verizon, Intel, Coca-Cola, very stable and long-term dividend payers. This index dropped in the last market crash, around the same amount as the S&P 500. But during that time, you had an extra percent in dividends. So this is a safer alternative to the S&P 500. You will have a better time during a crash because of those dividends. But what if you want to play it really safe? You should look at consumer staples. These are things that people will need like food, cleaning products, everyday use products, and such. The Vanguard Consumer Staples ETF, with the symbol VDC, with a nice 2.36% dividend, and a bit higher fee of 0.1%. This fund actually has good returns over the last 10 years, 220%, so a return of $320,000 on $100,000 invested. But this is a slower moving fund overall, compared to the previous funds, 33% in returns over the past 5 years, compared to 51% in the S&P 500. But the benefit is, this fund only dropped 30% in the last crash, while the S&P 500 dropped 55%. Meaning holding this one if a crash is coming will save you a lot of money. This is because we have very safe companies like Procter & Gamble, Coca-Cola, PepsiCo, Walmart, and Costco. all companies that will thrive when consumers need cheaper products. These are all great single stocks to hold for the safer part of your portfolio. All 4 of those funds are pretty good, but not as exciting. Let's look at a fund that might spike up nicely. The Vanguard Information Technology ETF had a return of 400% in the past 10 years, but a high expense ratio of 0.1% and low dividends of 1.21%. Let's see what makes up this fund. This one is very focused on technology, which blew up in the past years. We have the usual in Microsoft, Apple, Visa, MasterCard, Intel, Cisco, Adobe, Nvidia, Micron, just to name a few. This is for the believers of technology growth. It's higher risk in comparison to others. With more risk come higher rewards. This actually dropped only 40% in the last crash, bouncing back pretty fast. Maybe because technology really blew up in recent years. Vanguard has an incredible amount of choices. There are over 30 funds with low expense ratios. We just saw one focus on technology. They also have funds focused on communication, consumer staples, energy, financials, industrials, one for every sector. If you want to diversify outside of America, they also have funds focused only on international stocks, or the whole world excluding America. I recommend going to the site for a detailed look, but every fund I looked at in this video works perfectly. It's a matter of your preference, and what do you think the world will bring in the future? Personally, I would buy safer funds at this time. A market crash can definitely come in the next 1 to 3 years. It's been 11 years since the last one, and on average, we see one every 5 to 10 years. This could be a small blip of 20 to 30%, or something bigger at 50%. And the final thing I want to teach you is the best way to buy these funds. Leave a like if you made it this far, and leave a comment with your favorite fund. You should definitely not buy these funds all at once. This is the wrong way to buy index funds. This is because if the market starts dropping tomorrow, you will only be back holding for a long time. Imagine if you started with $10,000. You're on Robinhood, Webull, or M1 Finance. What should you do if you want to buy a Vanguard fund? Let's say VOO. I'll show you what I personally do with my money. Dollar cost average. This just means buying in slowly, over the course of a year or more. You buy in every month or 2. This way your average price is lower if the fund starts dropping. Here's a chart of 2007's crash. See how the price keeps sliding down? If you bought at the top, which we might be at now, it would take you over 6 years to break even, meaning 6 years of not making money. That would be very discouraging. What if we bought in at 10% of our money every 2 months? By the end of the crash, our average price might only be somewhere in the middle, and in 2 years we're in the green, and continue to make money for 10 more years. So we want to buy in as low as possible. This is true for stocks, and this is also true for passive index funds. If we were the luckiest people ever, and bought VOO at 100, and it pops back to 270, we made 170% very fast. But since nobody's that lucky, we can just buy it on the way down, and maybe get an average price of $180, still giving us a 50% return instead of being in the red for years. If you follow this simple principle, you will be a great investor with just one stock in your portfolio. You can be a millionaire by retirement, possibly a multi-millionaire. Remember, just $400 a month gets you $2.5 million in 40 years. With 800, you'll get there much faster. I hope I taught you something today, and if you want to learn more about passive investing, or even active trading, check out Monk's Market Mastery in the description below. It contains over 24 animated videos just like this one, giving you a lot of value, especially at 50% off. And remember to check out the 2 free investing apps below. It's what I personally recommend. Subscribe, hit the bell, and leave a like for more investing videos. I make them every day. Keep watching to invest passively, the Monk Way.